You see, there are opportunities for you to make money, bad money, in this market, but you got to know how to spot them. In fact, it is not an exaggeration to say that there are a lot of circumstances where Wall Street is making it much, much easier for you, for reasons that are self-interested for them, to make mad money. So how do you find these opportunities to make easier money quickly? How do you evaluate and analyze them to know that they're safer? All right, there are two kinds of situations where you have a legitimate chance to turn a profit almost instantaneously. Initial public offerings.
All aboard!
Which I've told you how to play in detail before. And then my favorite, those secondary offerings, where a company that's already listed issues new shares to you directly from the broker. Not from the seller, but from the broker. Tonight, I'm going to teach how to make money off these secondary offerings the way that I outline in my book, Getting Back to Even, where I spend about 7,000 pages on it because it's so important. But before we get to the methods for sorting out the good secondaries from the bad and the ugly, the money makers from the money losers and impoverishers, you need to understand how the credit market works, the corporate credit market, okay, not your credit card, because it's the indebted status of so many businesses that creates these opportunities to make that quicker money in secondary offerings. So, by the way, bank doesn't care that you did it in secondary offering. It's money. We have far too many indebted companies in this country left over from the big boom of the 2000s, where we just added a lot of debt to the balance sheets. And they're now selling shares through equity offerings, secondaries. They take that money that they raise in the equity market, and then they go pay down their debt. This is part of the process known as deleveraging, a term that you've probably heard, I'm sure you've heard hundreds of times, but always wanted to know what it really is. What I'm telling you, those secondaries, take the cash, pay down the debt. That's what it actually means. If you want a classic example of deleveraging, of a company reducing the debt on its balance sheet, then some of these secondaries fit perfectly as the companies take the capital they've raised from selling new shares of stock and use it to retire their old debt. I wish they had like a Wikipedia entry for this. Probably will have to watch the show. It was nearly impossible for businesses to raise money when we were in the real depths of the credit crisis. No one was going to give anybody else a dime. No one trusted anybody. Hey, we pulled money out of our savings account. And now many of them are taking advantage of their higher stock prices since the bottom, and the simple fact that there are enough investors willing to buy to support all the new stock that's been introduced in these market by these secondary offerings is rather astonishing. Now, it usually stinks in the short term when you own stock in a company that announces it's doing a big secondary, as an equity offering creates new shares of stock, and those additional shares make each pre-existing share less valuable. That's called dilution. You own less of the enterprise, right? You've been diluted. But there are secondaries where the stock then launches itself much higher after the deal. And if you can identify those offerings, and I will help you, then you can turn a big profit in a short period of time. Many of the stocks that are doing secondaries, but not all of them, are wrapped up in what I call a virtuous bullish cycle involving debt, which is why I'm explaining how the credit market works. Share prices go down. That allows them to raise more money selling the same number of shares in a secondary offering, and the money from the secondary improves the company's capital position, their balance sheet, which then takes all kinds of worries off the table, lets it refinance its debt, which in turn sends the stock even higher, allowing for another advantageous secondary if it's necessary. And we saw a lot of that in real estate investment trust business. This is how the capital markets are supposed to work. But remember, the credit markets froze up during the crisis. Stock market tanked. Became extremely difficult for most companies to raise any moolah. Think of it like this. We had a huge clog in the system that created a major backlog of heavily indebted companies that may have wanted to do a secondary. Remember, you got to have the plumbing in a house working. This was the plumbing, but not at the prices the market was offering. Not in such a bearish environment. Many people were frightened of doing anything that might have banged their stocks down because money was fleeing the market. And most stocks that went down either stayed down or fell even lower. In short, for over a year, it was just a really bad time for businesses to try to raise money using secondary offerings. But then the atmosphere improved. Wall Street hates when a company has a huge debt load that's coming due soon, and this is what drove a lot of stocks down and continues to do so. That's the kind of thing that inspires a company to get serious and either refinance its debt by issuing new bonds or to raise money by doing the secondary. Remember the way it works. Corporations don't borrow money the same way you or I do. A public company doesn't just go down to its local branch of Wells Fargo, say, hey, listen, I need a couple of bucks. When corporations need to borrow, they got to go to a different kind of bank, an investment bank that will help them issue bonds, either in a private placement or a public offering. Yes, they can get a loan, but this is the big money I'm talking about. Company will then sell the bonds, and then it pays the bondholders, its moneylenders, interest every year on the money it borrowed. That's called the coupon. Just to make all of this sound more arcane, ensure that it's difficult for lay people to understand. That's how I often thought when I got in. It's like, the coupon. Well, why don't you just make it impossible for us? This goes on until the bond matures, which has nothing to do with going through puberty or any other developmental phase. It's more jargon that means when the principal comes due. And with most bonds, the entire amount of the principal has to be paid back on the maturity date. All right, if that sounds too complicated, and that, look, that's the straight facts of what it is. Now I'm just going to tell you how you should think of it. I just want you to think of corporate bonds as a mortgage. In terms of mortgages, you're probably familiar with that. Bonds, they're not structured like an ordinary 30-year fixed-rate mortgage where you pay back some of the principal on the loan every month along with the interest. Instead, they're more like interest-only mortgages that let you skate by with lower monthly payments made up solely of interest until, usually after 5 or 10 years, sometimes longer, the principal has to be paid back all at once. Just like the homeowners who took out interest-only loans and needed to be able to refinance or face foreclosure when they reached the end of the line, where they would have to pay back the entire amount of the loan, a company with a whole bunch of bonds that are about to mature needs to be able to refinance, like you, unless it has enough cash on hand. Most don't. Some of the best secondary offerings we've seen since the crisis have come from the companies that were most heavily in debt, the uglies, the real uglies. That's why their stock prices soared after the secondaries, because companies were able to instantly put their new cash to use in a way that made shareholders find their stocks more attractive, more surety. Hey, let's take one, U.S. Steel. That's how a company like U.S. Steel prices a secondary offering just in the 20s. Could then see its stock levitate $11, taking it to $36.82 for a 44% gain over 30 days. Wow, that's like a takeover. It's how a rock and asphalt maker like Vulcan Materials, an aggregate company, could price the secondary offering at 41. Stock goes immediately to $47.25. Don't you want some of that? We've had great deals and huge wins in stocks like Ford, priced at secondary at $4.75. One I told you I just loved. It's about $1.50 below where it was trading the week before. That was an irresistible value, even if you hated the autos. And from what's known as the print price, where the deal came, it soared to $6.18. Ready? 30% gain in 3 weeks, to say nothing of the massive gains in the months that followed. What do all these deals have in common? They happened when bond and bank creditors put the proverbial guns to the heads of the companies, okay? They forced them to raise cash. The secondaries turned out to be fabulous places for ordinary investors to buy because they were part of that virtuous circle of deleveraging that I gave you. All right, here's the bottom line. Companies with lots of debt can give you the absolute best chances to buy their stocks and turn a quick profit when they do their secondary offerings. You just have to look for it and know how to analyze them.